The opinions expressed are those of the host. The material is for informational purposes only. It does not constitute investment advice, and it is not intended as an endorsement for any specific investment. Visit CrestmontPW.com for more details.
Welcome to the Ascent. This is Sam McGee with Crestmont Private Wealth. We have offices in Boerne, Texas, in the Hill Country, and the great energy capital in the United States, Houston, Texas. My name is Sam McGee. I'm the CEO and owner of Crestmont, and I want to talk a little bit today about exchange-traded funds. Now, we're not talking about any specific fund. This is not a product recommendation. This is just simply a show that we can archive and keep and share with clients, prospective clients, members of the community that don't really understand what an ETF or an exchange-traded fund is. And the reason I'm sharing this is because it comes up a lot. It just does. And let me go back in history a little bit and explain why I think that is. So as the financial services industry matured, back in the 1920s, the Roaring 20s, and then the Depression, it all kind of started with exchanges for stocks and bonds, commodities, physical goods, physical assets, contracts, and basically it's evolved. And the landscape of the evolution of investment management and access to investments has changed dramatically in the last century. And it's not just because of digitization and the computer, that played a big role, but it started back really in my lifetime, and I'm 50 now, where mutual funds became kind of the rise of access for the average investor, the retail investor, the person that wanted to get broad diversification of stocks but couldn't go out and buy 500 of them would go and purchase a mutual fund. And a mutual fund would be regulated under securities law, and it would be essentially a vehicle that would allow for a manager to buy and sell securities. There would be a price at the end of the day, after the market close, and they would reconcile what that net asset value would be every single day, and they'd report it to the custodian. So it became a vehicle for people to invest and get diversification through a mutual fund. And there's different types. There's closed-end, there's open-ended, there's ones with commission and load, and then there's institutional that are no load and low cost. All sorts of different types of mutual funds. And I'm not going to get into that today because it's just too long to explain. It's probably like 3 shows what mutual funds are. We're talking about exchange-traded funds and what those are and why. Why do we keep hearing in the public, in books, in the newspaper, exchange-traded fund? What is it? Well, what happened was investors really started demanding a more tax-efficient structure than a mutual fund. And let me explain the tax inefficiency of mutual funds inherently in their structure. So mutual funds will have, as I mentioned, a manager that is buying and selling, redeeming and purchasing securities inside the mutual fund as part of their management. Well, if you can imagine, in any given tax year, that mutual fund manager may have bought and sold hundreds of securities, and you get to the end of the year, and maybe there's gains that have been incurred throughout that year. Well, if you've ever heard of this, and if you haven't, pay attention to this, the pass-through of taxation at the end of the year, there can be some of that pass-through to the investor. And so mutual funds are not always completely tax efficient because you could have bought a mutual fund or invested in a mutual fund in the middle of the year and you get to the end of the year and then you have this kind of what we'd call a phantom tax associated. Now, I'm not a CPA, so consult your CPA if you need tax advice regarding your mutual funds. This is just simply a educational guide on how ETFs evolved and what they are. So anyway, they're not super tax efficient. So what happened was the industry evolved and the landscape evolved towards the kind of the birth of the ETF industry. And really that started, if you want to go back in history, with the crash of 1987 and also the technology bubble, that really kind of gave birth to the ETF industry in a nutshell. So the way that they work is they operate on an exchange. So they are exchange traded. So ET, exchange traded, which means that just like a stock trading on an exchange traded fund can also trade on an exchange. So they have the ability to be purchased, the ability to be sold intraday, in the day, versus mutual fund. If you put in a sell order, you're going to get the price at net asset value at the end of the day. So there is a huge difference in terms of ability to sell or buy at a certain price versus a little bit of blindness on what you're going to get if you buy or sell, because you won't know until the end of the day without precision. So that's one improvement, in my opinion, from mutual funds to exchange-traded funds. Now, initially, exchange-traded funds were developed to really mimic indexes. So, for example, there are countless ones out there that mimic the S&P 500 or the Russell 2000, very common indexes, or the Dow Jones Industrial. ETFs initially were designed to get exposure to mimic indexes, which means that manager was holding the same securities that were in those indexes, right? Makes sense? So if you were to buy an ETF of the S&P 500, you would hold a single security, an ETF, that inside of that had exposure to the 500 top companies in the United States. So I explained one difference: intraday trading versus end of the day pricing between mutual funds and ETFs. The other piece that's kind of interesting is that the costs of ETFs are generally, not always, but generally a lot lower than mutual funds. Broader access is generally a good thing for clients to have freedom of choice for how they invest. So whether you prefer mutual funds and having active management at a higher cost, or ETF for an index at a lower cost and getting broader exposure, both, that's a good thing. Having choices is good. So the tax difference, and again, I've got a caveat that I'm not a CPA. Get tax advice from your CPA. The tax difference and the efficiency of ETFs is a lot different than mutual funds, because if you're buying and selling an ETF, you are getting the price at which you purchased, your cost basis, and when you sell it, if it's at a gain, that is your gain. If you sell at a loss, that is your loss, versus being somewhat commingled with other investors and the tax treatment with the associated tax gains at the end of the year passed through to you in a mutual fund. The other thing that has kind of happened over the course of the last, I'd call it 5 to 10 years, is a lot of the custodians have allowed for free trading of ETFs. Not in every case, but a lot of the major custodians will allow for the free trading. And some of the mutual funds that are out there would have something called transaction fees or transaction costs. Or if they were non-transaction cost, they would carry a higher expense ratio. And so ETFs have become a lot more popular with wealth advisors and retail clients and high net worth investors in general, because they're just cheaper. I mean, in general, they're a lot cheaper. They're a lot more controllable in terms of being able to execute when you want to execute. And they're more tax efficient because you really carry your own basis with those. So really, this is kind of just a very quick flash overview of what an exchange-traded fund is. What we're talking about on the Ascent at Crestmont Private Wealth is, what is an ETF? Now, I'm holding in my hand a book that is the Comprehensive Guide to Exchange-Traded Funds. It's put together by the CFA Institute, the Research Foundation. Really good book. This is something that I think I bought several years ago. I'm a CFA charter holder, which basically means I'm a member of the CFA Institute, and they publish books time to time. And if you're really interested in learning a deep dive on what ETFs are, this book has a total of 14 chapters, everything from leveraged and inverse ETFs, which I am not a fan of, alternative ETFs, currency ETFs, fixed income equity, the history of it, a really deep dive. If that interests you, hey, you want to come by the office in Bernie, you want to borrow this for a couple days, we actually have a book library. No joke. We love to read at Crestmont. You want to come by, borrow the book, sign your name in it, return it, feel free to do that. We're happy to buy more of these too. But if this interests you and it's something you want to learn more about, and you can eat your heart out and just dive into this subject. But I think what we tried to do today is kind of explain what an ETF is. Our industry is full of acronyms. I mean, we're probably worse than, going to a hospital. It's just full of acronyms. And so when you hear that ETF, think exchange traded fund. It doesn't mean stock. It doesn't mean bond. It doesn't mean commodity. An exchange traded fund is a legal wrapper around a certain asset class where you want to get exposure and get invested in, typically in a fairly tax-efficient manner. There are exchange-traded funds now that have been developed to mirror mutual funds, just be in a more tax-efficient structure and be cheaper. So it's constantly evolving, which is very, very neat for the investor. I think it's a good thing to have access and have exposure and get a lot of broad diversification. As a fiduciary, we really preach that at Crestmont Private Wealth, but there's a lot of ETFs out there. So be careful if you're listening to this and you're evaluating them. One of the things that's really important is to evaluate liquidity, which is trading volume, market capitalization, which is size, and making sure that this is something that's going to be around. You don't want to have to unwind something that fails. And you also want to consider, track record. How long have they been doing this? Who's the underlying sponsor, the company, and what's the price of it? There's pretty expensive ETFs out there, and then there's cheap ones. So pay attention to all those details. At Crestmont Private Wealth, we do that for our clients. When we design and build our portfolios, and we do use ETFs in many of them, we evaluate that for our clients. Our investment committee meets once a month and as needed to evaluate all those criteria in the construction of portfolios in a prudent and diversified manner. I hope this has been useful to you. I hope you've learned something today. If you haven't and you want to learn something that's on your mind, reach out to us, info@crestmontpw.com. We love talking about financial literacy and finance. I hope this has been educational for you. Have a great weekend, and God bless.